Hey everyone, welcome back. Today, we're going to do a deep dive into yield farming.
Okay.
It's been a really hot topic in DeFi lately.
Yeah.
And frankly, when I first heard about it, I was pretty lost.
hmm
All these crazy acronyms and the jargon, it felt like I was learning a whole new language.
Yeah.
But underneath all of that, beneath the surface, there's something really fascinating here.
Yeah.
Something that has people buzzing, talking about the future of finance and all of that.
Yeah.
You know how everyone's always looking for that next big investment,
hmm
that secret sauce to really grow their money, right?
Right.
Well, imagine if you had a high-interest savings account,
Okay.
but for your crypto,
Right.
with potential returns that could make even, the most seasoned investors' jaw drop.
Oh.
We're talking hundreds, even thousands of % APY.
That's wild.
But what is yield farming, really?
Right.
And how does it actually work?
So it might sound kind of intimidating at first, but the basic idea is actually pretty simple.
Okay.
Yield farming, or sometimes it's called liquidity mining, is essentially lending out your crypto to decentralized platforms.
Okay.
Instead of just having it sit in your wallet, your Ethereum or your stable coins just sitting there idle,
Right.
you can put them to work,
Okay.
earn rewards, and those rewards are typically paid out in, you guessed it, more crypto.
Okay, so it's like lending, but instead of a bank, we're talking about these decentralized platforms.
Exactly.
Got it. But how does this farming analogy come into play?
Right.
I'm not picturing rows of digital crops, growing on a blockchain or something.
Right. Well, the farming part comes from the way you earn the rewards.
Okay.
Think of it like this. You're not just earning interest.
Yeah.
You're getting bonus tokens because you're providing a service to these platforms.
Okay.
It's their way of incentivizing you to participate.
Got it.
So you're not only earning interest like you would with a traditional savings account, at a bank,
Right.
but you're also harvesting these extra crops, we'll call them, these platform-specific tokens
Okay.
on top of that interest.
Okay, I see where the farming analogy comes in now.
Yeah.
But honestly, the how part is still a bit fuzzy for me.
Okay.
Can you walk me through an actual example of how this works in practice?
Sure.
Like, what would I actually do if I wanted to give this a shot?
Yeah, let's say you want to try yield farming on Uniswap.
Okay.
That's one of the most popular decentralized exchanges out there.
Okay.
Imagine you have some ETH and you have some USDT.
Mm-hmm.
USDT is a stable coin pegged to the US dollar.
Right.
You say, hey, let's put these to work.
Okay.
So you go over to Uniswap and you choose to provide what's called liquidity
Okay.
to a liquidity pool.
Okay.
It's basically like a big pot of money where people can trade between ETH and USDT in this case.
So it's like I'm creating a marketplace for people to swap their ETH for USDT.
Exactly.
Or vice versa.
Yep. And to contribute to this marketplace, you deposit equal values of both ETH and USDT into the pool. Now, every time someone uses your pool to make a trade,
Okay.
a small fee is generated,
Okay.
and you get a cut of that fee, paid out in, you guessed it, ETH and USDT.
Okay, that makes sense. So I'm basically providing a service to the platform
Yeah.
by enabling these trades.
Mm-hmm.
And in return, I earn fees.
Mm-hmm.
It's like being a mini bank,
Right.
but without all the paperwork and regulations.
Exactly. I
Okay.
like that.
Yeah.
But here's the kicker.
Right.
Uniswap doesn't just give you a cut of the trading fees.
Oh,
They also reward you with their own native token called UNI.
really?
So you're earning interest from those fees, and you're harvesting these bonus UNI tokens
Oh.
just for providing that liquidity.
So there are two levels to the rewards.
Yes.
The interest on my original assets and these bonus tokens. That's where the big potential returns come in, right?
Exactly.
Like those crazy APYs we were talking about.
Exactly.
Hundreds, thousands of %.
But remember, higher potential rewards usually mean higher risks.
Ah, okay.
That's something we're going to definitely get into.
For sure.
But before we do, maybe we can talk about why yield farming has become so popular.
Yeah.
It's not just about those eye-popping returns.
Yeah, there's got to be more to it than just the numbers. What else is drawing people to the corner of DeFi?
Yeah. Well, one key factor is the flexibility.
Okay.
You're basically earning passive income, but you still retain ownership of your assets.
Okay.
So it's kind of like having your cake and eating it too.
I like that.
And DeFi is global, right?
Right.
Anyone with an internet connection can participate.
That's pretty cool.
So it's truly breaking down those barriers of traditional finance.
I can see why people would be excited about that.
Mm-hmm.
But you mentioned the risks involved.
Yeah.
What exactly are those risks? It's starting to sound almost too good to be true.
You're right to be cautious. There are definitely risks, and it's super important to understand them before you jump in. One of the biggest ones is called impermanent loss.
Okay, that sounds ominous.
Yeah.
What is impermanent loss and how can it impact my investment?
Okay, so imagine this.
Okay.
You got your ETH and you've got your USDT
Right.
just happily working away in that liquidity pool,
Okay.
generating those sweet rewards.
Yeah.
But then the price of ETH starts to skyrocket, right?
Okay.
While USDT, remember, it's pegged to the US dollar, so it stays stable.
Right.
Now, when you go to withdraw your funds, you might actually end up with less ETH than you put in.
Wait, what? How's that possible? Shouldn't I be making more money if ETH is going up?
Yeah, that's where the impermanent part comes in.
Okay.
It's all about the ratio of assets in the pool.
Okay.
When the price of one asset changes a lot relative to the other, the pool rebalances
Okay.
to try and maintain like a 50-50 split
Okay.
in terms of value.
Okay.
So even though the overall value of your holdings might have increased, you could end up with less ETH.
Okay. I think I'm starting to see how this impermanent loss thing can be a real problem.
Yeah.
It's not just about the total value of the pool. It's about the specific ratio of the assets inside it.
Exactly.
That makes sense.
And it's important to understand that that impermanent loss can actually exceed the fees you earned, resulting in a net loss. It's not just theoretical.
Wow.
It's a very real consideration for any yield farmer.
Okay. I'm really glad we're unpacking this.
Yeah,
It's definitely more complex than just chucking your crypto in a pool and watching the magic happen.
for sure.
Are there other risks we need to be aware of?
Oh, absolutely. We've just scratched the surface here.
Okay.
There's also smart contract risk,
Okay.
which comes from the fact that these platforms are, governed by code, right? That can be vulnerable to bugs or hacks. And then there are the risks associated with the platforms themselves.
Hold on. We're just about out of time for this segment of our deep dive.
Oh.
But don't worry. We'll be right back after a short break to delve deeper into those other risks.
Sounds good.
And then we'll explore some strategies for, managing them all.
Right.
Stay tuned. All right. So before the break, we're getting into the nitty-gritty of yield farming risks.
Right.
We talked about impermanent loss,
Yeah.
which honestly, just hearing the name makes me a little nervous.
Yeah,
It seems like picking the right assets to pair is crucial.
it is.
But what other dangers are lurking out there for us would-be farmers?
Well, as you know, the DeFi space, it's kind of like the Wild West.
Okay.
Exciting, full of opportunity,
All right.
but also a bit risky.
Yeah.
Remember when we were talking about those smart contracts that kind of run everything?
Mhm.
Well, they're written in code.
Yeah.
And code can have bugs.
Right.
That's where that smart contract risk comes in.
Okay.
Even with audits, there's always the possibility a hacker could find a vulnerability and,
Right.
exploit it.
Yeah. So it's like building your farm on potentially shaky ground. No matter how good your crops are, a weak foundation could ruin everything.
Exactly.
Are there any ways to mitigate this risk, or is it just the nature of the beast?
You're exactly right to be thinking about that.
Okay.
Thorough research is key.
Okay.
Look for platforms that have been around for a while.
Mhm.
They have a good reputation
Okay.
and that have undergone multiple audits by, reputable firms.
Got it.
It's like checking the building permits before you actually, set up shop.
Okay. So experience and reputation matter.
Yes.
Makes sense. But what about the platforms themselves?
Right.
You mentioned they pose a risk too. How so?
Think about it.
Okay.
New DeFi platforms are popping up all the time, right?
Right.
Each promising these amazing returns.
Right.
But not all of them are created equal.
Yeah.
Some might be poorly managed.
Folks?
Some might be outright scams.
Oh, wow.
And even if a platform is legitimate,
Right.
it could still fail if it doesn't gain enough traction.
Okay.
Or if the team behind it, makes bad decisions.
It's like choosing which seed to plant.
Mm-hmm.
Some might be duds while others could flourish.
Exactly.
So how do we separate the wheat from the chaff, so to speak?
That's where due diligence comes in.
Okay.
Don't just blindly chase the highest APYs.
Okay.
Those sky-high returns could be a red flag.
Okay.
Instead, dig deeper.
Oh.
Look into the team, the technology, the
Mhm.
community behind the platform.
Okay.
Read reviews, join forums,
Mhm.
ask questions.
Okay.
The more information you have, the better equipped you'll be to make,
Right
it-
decisions.
research.
Yeah.
Research.
Exactly.
It seems like knowledge is truly power in this space.
Yes.
But there's one more risk we haven't talked about yet,
Right.
the regulatory landscape.
Yes, the elephant in the room.
Right.
The world of DeFi is still largely unregulated,
Yeah.
which is, can be both a blessing and a curse.
Okay.
It allows for this rapid innovation, but it also creates uncertainty.
Oh. Governments are still trying to figure out how to approach all this.
Yeah.
And, any new regulations could significantly impact how we actually do yield farming in the future.
So it's like the Wild West is slowly getting some law enforcement.
Yeah.
We don't know what the rules will be, but they're coming.
Exactly.
How do we prepare for that?
Stay informed.
Ah.
Keep an eye on developments in the regulatory landscape,
Oh.
both in your own country and, globally.
Right.
Understand that those regulations are constantly evolving and be prepared to adapt
Okay.
your strategies accordingly.
Got it.
It's a bit like keeping an eye on the weather forecast.
Yeah.
You might need to adjust your farming techniques based on what's coming.
Okay, so we've covered the big risks. Impermanent loss, smart contract risk, platform risk, and regulatory risk. It's a lot to consider, but I can see why people are still drawn to those,
Yeah.
potential rewards of yield farming. But let's be realistic.
Right.
For someone just starting out, it can feel overwhelming.
Yeah.
Are there any strategies to kind of help manage these risks and make this whole thing a little less daunting?
Absolutely. There's
Ah.
a variety of strategies out there
Right.
depending on, your own personal risk tolerance and goals. It's
Yeah.
like choosing what kind of farm you want to run.
Okay.
Some people are happy with, just a small, sustainable garden,
Right.
while others are aiming for, like, a massive
Yeah.
high-yield operation.
I like that analogy.
Yeah.
So what are some different approaches we can take?
Well, for those who prioritize stability and want to kind of dip their toes in
Yeah.
without taking on too much risk,
Right.
the Hodaler strategy might be a good fit.
Codaler strategy. That sounds familiar.
Yeah.
What does it entail?
It's all about using stablecoins for yield farming.
Okay.
Remember USDT?
Yeah.
Since it's pegged to the US dollar,
Right.
it's less volatile
Okay.
than cryptocurrencies like ETH or, Bitcoin.
Right.
So this significantly reduces your risk of impermanent loss.
So it's like planting a crop that's resistant to those,
Yeah.
crazy price swings.
Exactly.
You might not get the biggest yields, but you're less likely to lose your whole,
Right.
harvest.
Exactly.
Sounds pretty appealing for a beginner. What about those who are willing to take on more risk for the chance at bigger rewards?
Well, for those who are feeling adventurous,
Yeah.
there's always the option of using, more volatile assets
Okay.
like ETH or even altcoins.
Okay.
These can offer significantly higher returns.
Okay.
But remember, the potential for impermanent loss is also much higher.
It's like planting those exotic high-yield crops.
Exactly.
They have the potential to bring in a huge harvest, but they're also more susceptible to pests and unpredictable weather, all that.
You got it.
Okay.
With this strategy, you really need to be prepared to actively manage your investments.
Oi.
Monitor the market very closely.
Yeah.
And potentially even withdraw your liquidity quickly if you need to.
Right.
It's not a set it and forget it approach.
Okay, so we've got the cautious approach with stablecoins,
Right.
and then the riskier approach with, more volatile assets. What about something in between?
Well, some seasoned yield farmers use a technique called layering, or sometimes it's called stacking.
Okay.
It's kind of like taking the profits from one harvest
Right.
and using them to plant another crop on a different farm.
Okay, I'm intrigued. How does that work in the world of yield farming?
For example, you might earn UNI tokens from providing liquidity on Uniswap, right?
Right.
Then you take those UNI tokens
Okay.
and you deposit them on a lending platform
Okay.
like Compound or Aave
Okay.
to earn even more interest.
So it's like a double whammy of earnings.
Yes.
You're not just earning yield on your original asset,
Right.
but also on the rewards that you're already generating.
Exactly.
That's pretty clever.
Yeah.
But it also sounds like it could get complicated pretty quickly.
It definitely can. Layering requires careful planning,
Yeah.
a good understanding of different platforms,
Mm-hmm.
and constant monitoring.
Right.
It's not something I'd recommend for,
Right.
someone just starting out.
Fair enough. So we've got a range of strategies to choose from,
Yes.
depending on our risk appetite and, level of experience.
Exactly.
But I'm curious, where does yield farming go from here?
Right.
Is it just a fad, or is it the future of finance?
That's the million-dollar question, isn't it?
It is.
One thing's for sure. Yield farming has ignited like a wave of innovation in DeFi.
I can see that.
It's really pushed the boundaries of what's possible, and it's forced traditional finance to kind of sit up and take notice.
I can definitely see that, but like any new technology has gone through some growing pains, right?
It has.
Those early days of sky-high unsustainable APYs seem to be fading.
You're right.
Right.
There's a growing emphasis on sustainability now.
Okay.
Projects are realizing that to attract long-term users and investors,
They need to create,
Yeah.
more stable,
Okay.
reliable reward mechanisms.
It's like transitioning from like a boom or bust gold rush to a more sustainable form of agriculture.
Exactly.
Makes sense.
Yeah.
So what trends are emerging as yield farming matures? What should we be keeping our eyes on?
One exciting trend is the growing interest from traditional financial institutions.
Really?
They're starting to explore how they can incorporate,
Yeah.
DeFi concepts,
Yeah.
including yield farming,
Okay.
into their own offerings.
Wow, that's huge. So could we see a future where yield farming becomes mainstream,
Potentially.
accessible to, everyday investors?
It's definitely a possibility.
Yeah.
But it also raises those questions about regulation.
Right.
As more traditional players enter the space,
Yeah.
governments are going to be paying even closer attention.
Right.
And new rules could, really change the game.
It's like the Wild West is slowly becoming a more civilized town,
Yeah.
but that doesn't mean it's going to lose its frontier spirit. It's exactly.
It's going to be fascinating to see how it all plays out.
Absolutely. And the beauty of DeFi is that it's constantly evolving.
Right, yeah.
New platforms,
Yeah.
new strategies, new innovations are emerging all the time.
Yeah.
It's a space that really rewards curiosity
Yeah.
and a willingness to learn.
Well, we've certainly learned a lot today.
We have.
From the basics of how yield farming works to the risks and the strategies involved, and even a glimpse into the future
Right.
of this, rapidly evolving space.
But before we get ahead of ourselves,
Yeah.
maybe we can take a moment to recap those key takeaways
Okay.
from our deep dive so far.
Okay, so let's do like a quick mental inventory here
Yeah.
of what we've kind of harvested from this deep dive into yield farming.
Right.
It's more than just tossing your crypto into a pool and hoping for the best.
Definitely not.
Right.
Like we've been saying,
Yeah.
yield farming is all about putting your crypto to work on decentralized platforms.
Right.
You're essentially lending it out and earning those rewards.
Yeah.
Kind of like a high interest savings account, but with that,
Right.
DeFi twist.
And the rewards could be pretty sweet.
Right.
We're not just talking about interest here,
Right.
but also those additional tokens that some platforms give out
Yeah.
as an extra incentive.
Right.
It's what makes yield farming truly unique.
Yeah, it's that combination of earning interest on your lent assets and getting those bonus token rewards
Right.
that makes it so appealing to a lot of people.
Yeah, but, and this is a big bit,
Yeah.
we can't forget about the risks.
Right.
Impermanent loss was a big one that really stood out for me.
It is a big one.
Who knew that price fluctuations could actually lead to losses, even if the overall value of your holdings goes up?
Yeah, that's the tricky thing about impermanent loss.
Yeah.
It's not always obvious,
Right.
and it can kind of sneak up on you.
Yeah.
You really have to understand how that ratio of assets in the pool
Right.
affects your returns.
And then we learned about smart contract risk,
Yeah.
which is basically the risk that the code governing these platforms
Yeah.
could have,
Yeah.
like bugs or vulnerabilities
Mhm.
that could be exploited by, hackers.
Yeah, and we can't forget about the risks associated with the platforms themselves.
Right.
Some might be, brand new and untested.
Yeah.
Others might be poorly managed. And some might even be outright scams.
It's like navigating a field full of potential pitfalls.
Yeah.
That's why doing your research is absolutely essential.
Yes.
We talked about looking for platforms with a good track record, solid security,
Yeah,
a transparent team.
absolutely.
Don't just blindly chase those super high APYs.
No.
If something sounds too good to be true,
Right.
it probably is.
It probably is.
Right.
Take the time to understand how the platform works,
Mm-hmm.
what the risks are,
Right.
and what kind of returns you can realistically expect.
And then there's the regulatory landscape.
Yeah.
Which is, still very much a work in progress.
It is.
Governments are still trying to figure out
Yeah.
how to regulate the space, which adds, another layer of uncertainty.
It does.
Yeah.
It's constantly evolving landscape.
Right.
So staying informed about potential, changes
Right.
is key.
It could significantly impact
It could.
how yield farming operates
Yeah.
in the future.
So it's clear that yield farming is not a get-rich-quick scheme.
Right.
It requires knowledge, vigilance,
Yeah.
and a willingness to embrace a certain level of risk.
We talked about a few different strategies,
Yeah.
like the hodler's strategy, using stable coins for a more, cautious approach.
Right.
And then the option of using more volatile assets
Yeah.
for potentially higher returns, but also higher risk.
Exactly.
And we even touched on some more, advanced strategies like layering, where you take your rewards and reinvest them on other platforms to amplify your returns.
Yeah, it's a whole ecosystem out there.
There's something for everyone,
Yeah.
depending on your risk tolerance and your goals.
And who knows what the future holds? We talked about the growing emphasis on sustainability.
Right.
With platforms moving away from those, unsustainable, sky-high APYs towards more stable reward mechanisms.
Exactly.
And then there's that growing interest from those traditional financial institutions.
Yes.
It's exciting to think that yield farming could potentially become more mainstream, accessible to a wider range of investors.
But it also raises questions about how, increased regulation might impact the space.
It's going to be fascinating to see how it all unfolds.
It is.
Well, I think it's safe to say that yield farming, despite its complexities and risks, is a force to be reckoned with.
I think so.
It's pushing the boundaries of finance.
It is.
And challenging those traditional models in ways that we couldn't have imagined just a few years ago.
It's a testament to the power of innovation.
And the potential of, decentralized technologies to create a more open, accessible, and equitable financial system.
So for anyone listening who's feeling inspired to dive deeper into this world of yield farming, remember what we've learned today.
Yes.
Knowledge is power.
It is.
Research is essential.
Absolutely.
And always invest responsibly.
And most importantly, stay curious, keep learning, and embrace the adventure.
Yeah.
The world of DeFi is full of these exciting possibilities.
It is.
Just waiting to be explored.
Well, on that note, we're wrapping up this deep dive into yield farming.
Okay.
Thanks for joining us on this journey.
Yeah, appreciate it.
And until next time, happy farming.